Good morning, good afternoon, and good evening for wherever in the world you're joining this final session of a day focused on planning for business volatility. Keeping our cash remains the #1 priority for companies. And if there's one thing that the COVID-19 crisis has reinforced, it's the importance of cash and liquidity. For the last month or so, I've spoken with over 30 treasurers, and the one common topic this conversation has focused on has been liquidity. Queries have varied from cash forecasting, borrowing facilities, government intervention programs, and investment strategies. But it all comes back to making sure the Treasurer can ensure that for their business, there's sufficient funds in the right currency, in the right place to support the needs of the business. Here at the ACT, we continue to run a weekly liquidity survey, and results can be found in our COVID-19 part of the ACT Knowledge Hub, and with other resources produced by the ACT with links to resources from other options. And I'd encourage you to bookmark it and return as and when to see updated information. If you've 30 seconds, please complete the survey, even if you've done so before. It really helps us understand how sentiment across the Treasury community is changing, and it's a key topic of interest when we talk with the Bank of England, HM Treasury, and the FCA. Our last survey results showed a worrying increase in concerns about liquidity and confidence across the supply chain compared with the previous week. I'm hoping it's a slight blip rather than a more worrying trend. Now, before we get going, some housekeeping. First of all, if I hear a fire alarm, I'm off. So you'll see a blank screen. But seriously, Q&A, please submit your questions via a box just above the session window. If you're joining via the web link, if you're joining via the app, the Q&A button is located at the bottom left, and all questions are kept anonymous, so please don't be shy. As you'd have heard from previous sessions, this is being recorded and the proceeding will be made available for you to watch again at your leisure on the event portal soon after the session finishes. We're running a virtual discussion forum, which allows you to share your comments, ideas, and takeaways about the session with speakers and fellow attendees. And finally, please get engaged with the ACT on social media. Join the ACT's active LinkedIn groups, follow us on Twitter at ACT Update, and tweet using #ACTITW. And from me, as our guests you've come to hear today, Paul Harrison, Eric Peterson, and Steve Wheeler. Steve Wheeler is the Treasury Director for Dialog Semiconductor, a UK headquartered international semiconductor company primarily focused on the development of integrated circuits. It's a key supplier to many of the largest consumer electronic companies and supports a range of products for the connectivity of the so-called Internet of Things revolution, such as Bluetooth low-energy chips. In 2019, $1.6 billion in revenues, has over 2,000 employees, and a career of almost 30 years. Steve has worked for BG Group and Thames Water before joining Dialogic last year. Eric leads KPMG's multidisciplinary corporate treasury services group in the UK. He started the audit practice in Texas before taking a treasury focus 10 years. He now focuses on technology and enabling transformation and change. Paul Harrison leads Grant Thornton's advisory, assisting a wide range of clients on a variety of issues, and has over 25 years' experience in treasury roles, BAT, Diageo, as well as PC, and then PMC Treasury, a global consultancy offering financial risk management and operational treasury services, where he helped lead the treasury activities. Now, first of all, I'd like to talk about some good practice frameworks, and in your experience, what are the key components of good cash management?
Naresh, thank you. I think you summed it up very well earlier on in terms of thinking about liquidity, in terms of getting cash in the right place, in the right time, in the right currency, the right entity in order to support the business in doing what it needs to do, whatever that activity is. I think a lot of people on the call, I hope, would agree with me that quite a lot of this is just about getting the basics right. And so it's about making sure that your pooling works, making sure that you have visibility of all the cash absolutely everywhere, making sure the cash flow forecasting works as well, that errors are being checked, that forecast to forecast drift is being managed and thought about. That's where the forecast for a particular period drifts over time and in a potentially a systematic way. And it's also about making sure that things like the intercompany loan framework works, so that you don't have lots of little pots of cash absolutely everywhere. I think others will talk about working capital and the like, but I always think about liquidity management about getting a lot of little things right in that way.
Steve, you've been a treasurer for many years. How well have you seen cash and liquidity management undertaken in practice?
Thanks, Naresh. Yeah, I mean, generally pretty well. I think where it does sometimes fail is where you don't have a clear set of objectives, and for me, that's the absolute key. I mean, the fairly obvious objective is having enough cash to operate the business, but there can be other very justifiable liquidity objectives as well, such as achieving particular financial risk profiles under rating agency classifications, or satisfying the test for achieving going concern or supporting going concern statements in accounts, or managing financial covenants. At Dialog, it's been a big priority has been realizing our strategic growth objectives. So we've been holding quite a lot of excess liquidity to give us that agility to commit to M&A transactions. So I think liquidity management has to be, and setting those objectives has to be very company specific, and is very much more an internal than an external benchmarking exercise. I think sometimes it fails where people look very much at the external market, whereas I think it really has to be very much more internally driven and working through Treasury, but also company-wide to set those objectives.
So there's a lot more around setting, not one size fits all, but actually listening to what the company requires and building more of a culture around that.
Exactly, and having those, not necessarily a single objective, but maybe a suite of objectives and monitoring performance against those.
Okay. Now, Paul, with your advisory hat on, what have you seen in practice, and where do you think companies typically fail?
Well, I mean, one thing I would say to add to some of Steve's comments just there is in a dangerous situation such as we are potentially at the moment, or in a situation, a particular organization where it's distressed, or there's a transaction that's just occurred where it's been carved out and set up from scratch. The reality is that liquidity is it. Yeah, it's liquidity in banking. It's about being able to pay your suppliers, pay your customers, pay your people in a way that allows you to operate. To answer the question you actually asked, though, where we see a lot of the time, and I'm thinking of 3 or 4 clients at the moment, where sometimes there's some of the practice that can be questionable, is sometimes actually they, in addition to not having the right processes in place, they end up becoming reactive, and they end up having, if anything, too much of a cushion. So many organizations that we've been talking to lately have actually had an RCF with very large, very safe, very well capitalized banks, some of the largest in the world, and yet they've drawn down their RCF completely. Now, particularly if you're private equity owned, which is a big part of my market, if you are highly leveraged, you can quite easily be paying 4, 5, 6% as a margin on your RCF. If you're drawing down millions and tens of millions of excess liquidity simply because you're worried about your bank, that can be a very expensive insurance policy. But what it can also do is, leaving aside any counterparty risk that the company perceives, or perhaps wrongly, it can also be indicative of a reactive approach. So you don't know, and therefore you're going to make sure you have a big cushion. And again, all of that can be very expensive, and indeed can even lead to a situation where, again, picking up on one of Steve's comments, it allows you to not be nimble. The final thing that often concerns me is if people have cash as an insurance policy, or if they have it as a contingent requirement, they're going to make an acquisition, they're going to invest in something, that they start to talk about yield. Most of the time, I think, from a liquidity perspective, they should be thinking more about just how safe is it more generally, and if they are concerned about there's ambiguity or uncertainty about the currency of what they're going to use the cash for, be thinking about that currency mix, rather than just thinking about, can I get an extra 0.1% over the next year? Those are the things that we tend to find.
And let me just ask about, you talked about, and we'll maybe come back to it around us, but certainly the conversations I've had both in the UK with Treasury US and in Europe as well.
Yeah.
There has been a lot of treasurers who've drawn down on RCFs when they don't
Yeah.
actually need the money.
Yeah.
And I wonder if part of this is a generational thing. I mean, I was the treasurer during the great financial crisis where you tried to draw down from the banks and some of your banks went bust, some of them were very slow in terms of giving the money up. And I wonder if part of this is a board response to the fact that 10 years ago or a bit more, there was that real worry that banks wouldn't actually draw down on committed facilities.
Yeah, I think you make a very good point. I mean, I think one of the, leaving aside the ultimate health-related reason for this whole crisis arising, I think it's not too glib or cliched a statement to say that last time the banks were part of the problem or created the problem, whereas these days they tend to be part of the solution. Typically are quite well capitalized and are ready to support their customer base. But yeah, it really is, it is a questionable practice, and particularly if you're talking about some of the literally too big to fail banks. I would just say that have that RCF and use it perhaps in a more intelligent way on a going forward basis, which perhaps we can come back to.
No, it's a good point. We all come back to RCFs.
Yeah.
So just sort of taking us back to day one of the crisis, so it'll also be useful to know where you thought day one actually started. Just know what you found happened in practice in those days. So Steve, over to you. When was day one and what are the first things you got going?
Yeah, I mean, for us, I guess organizationally, it hit us fairly early on because we have operations in China and Korea. So I guess we were aware of the crisis and having to deal with the crisis at a local level, certainly during January, and it's really kind of built from there. I mean, we do have, and I'm a member of the our internal committee, the Risk Management Office, that deals with and is responsible for, amongst other things, kind of monitoring and reacting to emerging risks. So we had all of the process and the organizational infrastructure in place to deal with things, and then and I guess I was plugged into that debate and those developments. From a treasury and liquidity point of view, we're already in a pretty strong position in the sense that we had cash pooling in place. It meant that most cash is held centrally, so we have good visibility and good control over cash, and a relatively prudent treasury policy. It's always been about security and liquidity rather than yield for us. So it was really about kind of adapting our approach and making sure we kind of took the steps to understand risks and how they were evolving during the crisis and as it developed. So, for example, on the monitoring the credit risk of our banking counterparties, we would traditionally do that on kind of at least on a monthly basis. Mm-hmm. We're now looking at CDS levels for our banks literally on a daily basis. It's the first thing that's done first thing in the morning to kind of just make sure we're monitoring anything happening there. Similarly, on money market funds, we're being a lot more proactive in terms of looking at the underlying assets that are held in those funds, doing look-through analysis so we understand the credit risk that's within those funds as well. And the third thing that we're kind of doing more of is kind of scenario-based cash forecasting. So I think clearly we were already doing cash forecasting, but due to the uncertainty around potential impact of this current crisis, we've taken a lot more kind of scenario-based approach and looking at how liquidity and covenants and everything else could develop under those different scenarios.
And in terms of systems, do you use Excel for your cash forecasting or something a bit more bespoke, customized?
We currently everything is Excel based, but we have pretty good controls around that.
And it does everything you need it to do?
Yeah, it does. And most from a kind of treasury operations point of view, pretty much everything we use is cloud based. So yeah, in terms of the impact of people working from home and being able to operate on a day-to-day basis from home, we've been pretty pleased with that.
And just sort of picking up one of your earlier questions around visibility of cash, do you have just one bank providing all your banking operations, or you've got a lot of banks? Can you just tell us a bit more about the infrastructure you have?
Most of it is through, as I say, most of our cash is pooled. We have multi-currency pooling arrangements with a single bank. There are exceptions. There are, accounts held with other banks where we have to do that for particular reasons in particular jurisdictions. But most of it is through a single bank.
Brilliant. And Paul, what's your own experiences of clients taking you back to those early days of this crisis?
Well, again, it comes down to what the questions have been. So, are there better ways, safer ways of investing any surplus cash we have? Can we talk about cash flow forecasting? Can we talk about short-term liquidity management? And what are other people doing? And again, coming back to some of those basics that Steve was talking about, talking to them about why you make sure that you have multi-currency cash pooling if you're larger, and at least visibility of bank balances if you're smaller. The one thing I would say also is, as a consultant, perhaps you might say I would say that, but is when it comes to systems, I'm actually quite a fan of, as you describe them, bespoke or third-party cash flow forecasting systems. And I'm working with a couple of clients at the moment with those, whereby I think for a relatively inexpensive outlay, you're able to put in place a very effective system that allows you to link with the ERP, link with your banking, allow you to check errors, allow you to consolidate, and allow you to slice and dice the cash in a number of different ways. And I think that really has a real value, particularly when, as they are now compared with even only a few years ago, they're very, very quick to put in, and they're very intuitive to use. A couple of the suppliers we work with, they're quite proud of the fact that they've hardly ever lost any customers. And that is in spite of, in some cases, also having a TMS or an ERP and the like. And I think if you're able to let a system take away a lot of the strain, it allows you to then focus, as is always the case in these ways, on the problems rather than getting the information in the first place.
Very good. That's a good segue. Eric, you spend a lot of time with fintechs. We heard yesterday from a couple of technology vendors, Ombre, TIBCO. What's your technology gaps for Treasury teams and some insights there?
Yeah, no, I was reflecting on some of the sessions from yesterday and our excellent technology presentations. I think one of the other aspects beyond technology that really struck me yesterday, Naresh, was some of the aspects that talked about some of the silos that have been brought down, right? How Treasury was now interacting with the broader business in a way that they hadn't before, and making new relationships and understanding this immense value that Treasury can bring across the organization. And of course, that brings us to these organizations now being much more connected in an oddly unconnected way, right? But they're also then saying, well, to the point of this whole discussion is cash is king. So they're getting a lot of discussions coming to them from the CFO, trying to understand what is their cash position, what is their forecast, how are they optimizing working capital, what does their supply chain look like? And these guys that now the silos are down, they're really galvanized around addressing this crisis, and then there's looking down at their systems and seeing that there are some significant gaps. And I think in particular, sort of a lot of the larger, more global groups, I think there are sort of, if I was going to put those in three different areas, I think I'd do sort of data, connectivity, and then actual technology itself. And if I just start with the data elements, so a lot of people maybe think of these sort of really large groups as having amazing interconnected data, but the fact is they've often grown through elements of acquisition, and they have fragmented ERP systems, and actually getting at the data, the underlying data that then rolls up into a forecast that then can be really usable from a CFO perspective to make real business decisions is difficult. And there is a number of technological solutions that are being put in place to be able to address sort of structured and unstructured data in various places that can then be pulled together. So the reliability of data has become a significant issue for some groups that have sort of muddled through it previously and are now really understanding the importance of data and getting their arms around it and having data that allows them to make useful decisions. I think the next piece is connectivity, and so this isn't new, right? So we've always talked about this sort of nirvana of golden data that is then utilized across the entire organization and everything's connected. But when we actually go look at some of these organizations, different groups are using different pieces of technology that are not connected, and they're all sort of seeing different things. And so it's unsurprising that you then get people thinking about sort of different things because they're looking at literally different dashboards of information. And so the ability now with a lot of the technology to connect these sources of data and connect these systems such that everyone is sort of thinking and working in the same place and on the same sort of platform and same information is really become important in the in this sort of new world that we're living in. And that is incredibly important, as you would expect, around forecasting, working capital and cash management. And then if I go beyond that, there is then also the group where they're just finding that they don't have the sufficient technology in place to be able to address the risks that they have at the moment. So the risks have changed dramatically, right? The focus in particular on cash is paramount, and really getting cash visibility, getting an understanding of their forecast and some of the basic building blocks that a lot of groups might have has really crept up the sort of the platform for change, or sort of the key things that they need to address. And that is not only on the forecasting end, but also you've got some of these groups that just have this pool or have the good the good problem of oceans of cash that they need to think about, and where do they deposit it and how do they manage it. And there are also fintechs that are emerging in that space. So it's an incredibly interesting scenario right now, where we've got a lot of groups who are now really addressing those gaps, and there are a lot of technology solutions that can be put in place quite quickly. Actually, it's not sort of the cumbersome process it used to be to get those pieces of technology in place and make some real change.
And I guess just sort of pick up on one of your words around speed, that presumably not beyond the wallet of mid-cap companies.
Absolutely not. And so the groups that maybe didn't have a TMS at all, or maybe didn't have forecasting, those putting those in place, I can't see why you wouldn't do it. The barriers to putting those elements of technology in place are so de minimis in the scheme of what we're dealing with as a crisis, that it is to me a no-brainer at the moment.
And it's interesting, I was talking to a couple of technology TMS vendors last week before about investments. Yeah. And bizarrely, they've seen an increase in requests from clients, either existing clients or new clients. And they've, on this basis of we're all in it together, they've been happy to have conversations about financing these things, because they know people need the solutions now. They don't actually have them today, and actually they're happy to have these conversations. I don't know what comes of them, but what was very clear is they said treasurers should not avoid having conversations with potential TMS providers, because there is a lot of support out there to help them deliver these things. So
I think that's the entirety of the community, Naresh. Even the ACT, all the groups are happy to have those conversations about whatever issue they might have and what solutions might be available. And you'd be surprised that the barriers you might have thought about previously, that there are some solutions that you might find palatable. Yes.
Excellent. I'm sure we'll come back to technology again. It underpins so many things that we do. I want to talk a bit about some of the to generate cash and liquidity. We study, and also from the ACT materials on cash management. Organizations have traditionally managed working capital very aggressively. We see moves now to be supplier centric. In the conversations I've had, again with treasurers globally, we've seen deferments of OPEX, CAPEX, discussions around and dividends. I want to sense from each of you how you feel about each of them, and how your decisions have changed from early on where we are now. Steve, can I turn to you first?
Yeah, sure. I guess we're in the very fortunate position that, at least to date, the impact on our business has been relatively modest. So for us, it's more about scenario planning to understand the potential possible futures and the levers that are available to us both inside and outside Treasury to deal with those different scenarios. We're not an industry where payment terms are traditionally particularly long. So kind of working capital management in itself is not a big issue for us on either side. I mean, we do use factoring. We factor some of our receivables, so that helps manage both kind of customer credit risk and liquidity as well. As far as kind of cutting non-essential spend goes, I think we're not an organisation that I like to think we're not an organisation with a lot of non-essential spend. We don't have a big corporate overhead. Around 77% of our employees are engineers, and they're really what kind of generate the value in our business. It's the IP that they develop, and we have to continue to develop that IP to remain competitive. So we have to be prepared to continue to invest in those things.
And one of the things around sort of supply chain, have you been focusing a lot more around vulnerability across the supplier base?
Sorry, say again? I didn't catch that.
In terms of your supply chain, have you been looking at your customers and suppliers and looking at any sort of financial vulnerabilities across these in more detail than you would have done before?
Probably in a bit more detail, but I think we're generally in a very good kind of position. The impact across the businesses and across the industry has been relatively benign to date, and we work with some of the biggest, certainly in the consumer electronics area, some of the biggest companies in the world. So we're in a fortunate position there. Okay,
brilliant. Paul, you talked earlier, you do a lot of work in the PE space. I assume it's all about taking as much liquidity out of these businesses and sort of hoarding it at sort of holding companies. Is that, am I right?
Not necessarily, no. I mean, what you got to remember is that the whole purpose of the private equity model, I mean, leaving aside the financial engineering element of it, is to buy an asset, probably inject a bit of good practice, often in a rather generic way, but good practice in a whole range of areas that include treasury management, but they're certainly not limited to that, and not limited to the financial management part of it either, and to take it out the other end being worth more than they paid for it. Now, so as part of that, the idea then that you're going to excessively suck cash out of it as a shareholder would be rather perverse, because if you think about it, the business is already highly levered. It's already deliberately been put under a certain amount of strain, and that's reflected in the high cost of credit and the low implied credit rating that all of those businesses have, if they have one at all. And so, no, in actual fact, I think a lot of the time the sponsors are very keen, whilst to make sure the business is viable, to support it as much as possible. So I don't think the idea that they would be looking to take cash out of a business that's already under stress further is really the case at all. And indeed, you know, a lot of the time with the financing that they have in place, you know, a big part of the requirements that they have is that if the covenants reach a certain level, the sponsor's required to put in an equity cure. Now, they may choose not to do that, in which case you see in the press that such and such a sponsor has handed the keys back, as the press always like to put it. But, you know, that doesn't happen often. You know, quietly, cures occur here and there all the time in order to support the covenants for the business if it's under pressure. And, you know, they do realize that cash is expensive, but and they don't want to waste money. And I don't think any sponsor is going to want to be thought of as throwing good money after bad. But if ensuring that cash remains in the business as a result of not taking out a dividend or, you know, being supported in whatever other way, I think that generally speaking is what they would do. Remember also, with a PE sponsor, they have visibility. So, you know, a PE sponsor typically owns between 50 and 100% of the business. You know, so they are part, albeit at a board level only, they're part of the management team. They do have visibility in a way that, you know, AXA owning 3% or the Prudential owning 3% of such and such a business, they don't. They're reliant upon the report and accounts and stuff.
And I know, Steve, when we talked about this last week, you were sort of sharing some of your experience with stakeholder management from, you know, where you are now at a PLC to when you were, you know, treasurer at Thames.
Yeah, I mean, it's as Paul just said, I guess one of the benefits of the PE model is that you can get your shareholders around a table and discuss the business and discuss issues and reach conclusions. Whereas clearly in a publicly listed company, you're that step further away from the ultimate shareholders. So that's has its benefits, has its challenges as well.
Okay, brilliant. And Eric, can you share some examples of good practice amongst clients and how they've used technology from a working capital perspective?
Yeah. So with this question, it's interesting. So I took this question to the entire team, and we started talking about the different elements of technology we've seen brought to bear over the last 8 weeks, and we're all talking through this and having a good discussion. And we're doing it probably through the best use of technology that's come through this crisis, which is the same bit of technology, honestly, we're on right now. The ability with Zoom and with Microsoft Teams to stay connected and be able to continue to motivate our people, keep them working hard, keep them feel like we're engaged, which we are. The ability to work with our clients, to be ability to, you know, still have even some engaging discussions that might go beyond work. That was very, very clearly the most important piece of technology over the past 8 weeks, and that clearly is not Treasury specific. But that enabling piece, because I guess we always talk about technology sort of being an enabler. It's not the actual answer itself, because this still comes back to people. And then the other piece, so I did think I probably needed to do something on Treasury, besides these great interactions that we're having through Zoom and Teams, is that the other really interesting thing that I think we're seeing groups do, and this goes back to Naresh, some of your points you made earlier, is this connectivity and trying to understand what other groups might be feeling, right? Is the interaction of Treasury with that supply chain. And so your supply chain is, of course, incredibly important to your ability to have products in the marketplace. And there will be different people across that supply chain which will be feeling different levels of stress. And so the degree to which clarity can be brought and certainty can be brought to that supply chain, then sort of some of the financing elements across that chain of supply they decrease, because certainty it brings a decreasing value on the premium for risk, because risk is reduced. And so we've seen a number of different supply chain type of arrangements that have been put in place and technology brought to bear in that area that I think has been really interesting. And I think that again is people working towards how do they work together in a very different way given the new environment.
Okay, brilliant. Paul, one of the things that we sort of you touched on earlier was around RCFs and committed facilities, and you talked about companies drawing down, and then I've heard, in fact, from some of my conversations, people drawing down on the RCFs and then deploy money straight back with the banks that they have borrowed from. Be interesting to hear experiences across from the three of you. Seen pressure from key stakeholders, including boards, investors, analysts, and rating agencies as well. Steve, could you share your own experiences around this, and what you hear from your peers?
Yeah, I mean, there's certainly lots of evidence, anecdotal and otherwise, about companies, and clearly there are many companies that are drawing down their RCFs. And clearly there's good and bad reasons for doing that. The most obvious good reason is where companies need the money, and there's certainly plenty of companies and sectors where that is the case. I mean, sometimes I think there's other probably less obvious good reasons, where, for example, there might be conditions precedent to draw down, or MAC clauses where companies feel comfortable today but might not be, or they can see scenarios in the future where they might not be able to satisfy those conditions. And that's as I say, an equally good reason to maybe draw down and wouldn't be apparent looking from the outside. And also just managing counterparty risk of RCF counterparties. But as everybody, I think, has kind of said, I think in this crisis, we haven't seen, I certainly to date, haven't seen a huge issue in terms of the major banks and the credit risk associated with them. But as I said earlier, that's something we're kind of monitoring a lot more closely. But as you said, it's difficult to see why anybody would draw on their RCF if they're concerned about credit risk from a counterparty and then deposit with the same banks. That doesn't seem to necessarily make much sense. So I think there are other good reasons other than the obvious ones, but I guess, and the single bad reason is because everybody else is doing it, and that is something that does worry me, that it kind of it's a domino effect, that people see other people who are maybe drawing for a variety of good and bad reasons and then worry that maybe they should be doing it too. I think that's not the case. And
Paul, across your client base, what's your experience?
Well, as I said already, unfortunately, a number of people have drawn down for a variety of the bad reasons. I'm not going to. None of my clients have been doing that in advance of worrying about MAC clauses and so forth. But certainly they have drawn down on the basis of it's better to be safe than sorry, despite having, as I said earlier, very large banks as their counterparties or as their lender that I think under most circumstances are not likely to go under. And if they did, perhaps we would have an even greater crisis on our hands. I think one thing I would do, which is perhaps a sort of a nuance on that debate and Steve's comments, is we don't always see clients using their RCF as flexibly as they might do. So what I mean by that is, rather than draw down all of it now, draw down what you need. But more importantly than that, draw down using more tranches. Most RCFs, in my experience, have 6, 8, 10 tranches. So just to use easy numbers, if you've got 100 million, you can quite easily have 8 or 9 tranches of 10 million, have 10 million in your back pocket for a rainy day or an even rainier day, and be constantly having a tranche coming up for repayment every week. And that allows you to use your RCF in a very flexible way, only have the amount borrowed that you need, always still have some available to be used, And so it means that over a period of time, the amount that is borrowed much more closely reflects the exact borrowing requirement you have. So again, you're not swimming in cash. You're not paying, particularly if you're PE owned, 6-7% on the margin to borrow and earning a basis point on deposit. Or I think you and I, the conversation about it's a negative basis points if it's euros. And remembering also that a lot of these facilities have some form of LIBOR floor as well. So, it's just a case of more actively managing. Liquidity management isn't just about seeing what you've got in the bank, working out how to best manage your working capital. It's also about actively managing your liquidity positively and negatively. And as I said before, also making sure that from a treasury, not a tax perspective, from a treasury perspective, your intercompany loan framework accurately mirrors and is able to facilitate getting those little pots of 50,000 here or there that very rapidly can add up for an international business. We often have businesses that have operations in obviously the UK, Sweden, South Africa, Canada, Australia, wherever. Now, South Africa may be a bit difficult, but certainly places like Canada, Australia, and Sweden, you can get that money back very, very quickly. And if you've got an intercompany loan framework in place that mirrors some form of pooling arrangement, particularly if you have an overlay bank, like I think, Steve, you said you do, that can both enable the group to maximize the amount of cash it holds centrally, whilst giving the local operating companies the comfort that, they might sail a little close to the wind in terms of total liquidity, but if there is an unexpected event, they have access to that as well. So it's about, intelligently managing what we're trying to do. All those other things that we talk about are means to an end. They're all in order to make sure that you have the right amount, not too much, not too little, liquidity being held centrally.
So the number one question is, and I've heard it in conversations with a lot of treasurers, the board have said to the treasurer, you need to draw down some or all of the RCF, even though treasurers probably agree with a lot of what you've said, a lot of what you've said. Do you have any sort of good arguments that you think treasurers can take away from this session when they go back to these board meetings?
Well, the obvious one is cost. And the other one is, if you have in place most or all of the framework, I said I'm not going to go through it again, intercompany cash flow forecasting, visibility, etc., then unless you have deep misgivings about the viability of your counterparty bank, then I'm not sure that just drawing that money down and then putting it in the bank, particularly if it's a bank that you had some misgivings about in the first place, is necessarily good practice. But the one argument would be money. The one would be cost.
And I guess,
and also I think, just kind of tactically on that, I guess one way of addressing that issue is kind of to address it on the front foot and to give the board the assurance that they need or that they seek that things are being well managed. So to say we're not drawing down on the RCF now, but these are the things or the conditions that we're actively monitoring, and these are the events, if they did happen, where we would consider it, and then maybe that gives them some assurance that it is something that's being looked into and actively managed.
Absolutely agree, Steve. And it's all about being proactive with your liquidity management rather than waiting until it all turns horribly wrong, or having all the cash that you could possibly ever need under most circumstances, which you haven't scenario planned, B. Yeah, agree.
And sort of particularly drawn, Steve, to your comment around monitoring things like CDS. So I guess it goes back to creating a transparent structure, which you're reporting regularly to the board and giving them that assurance that actually you do know what you're doing. And the answer is not just to in a binary way to draw down all the money up front.
Yeah, exactly. And as I said, but being prepared to say, but if X, Y, and Z happened, then we would. But as I say, there may be I'm sure there's other companies out there who have drawn down for very good technical reasons. So I think the other takeaway is is definitely kind of make sure you read all the clauses in your docs and understand the risks of not being able to draw down in the future if there are any.
That's a good point. Claire Francis, Standard Chartered, did an article for the ACT, I think, early on in this crisis. And I think what I took away was this comment I've heard from Gunn and other people, that there's enough liquidity. I mean, he didn't use the word liquidity, but enough liquidity for everyone's need. But if we all drew down, then like we find a real problem around accessing it. So it's about using what you need and being thoughtful. So I guess back to Paul, some of your points as well. We're sort of coming to the last 15 minutes. I wanted to think now about what you've been doing since this sort of crisis, hit. And I think as you started to get used to the sort of new way of currently working. Steve, over to you.
Yeah, I mean, for us, it's really just kind of, I guess, getting more granular in looking at those different scenarios and planning for different scenarios. It is an incredibly uncertain environment we're living in. But yeah, using this time to really kind of drill down, to increase the level of reporting. We're now doing kind of weekly credit risk reporting, and also, I guess, understanding how things are evolving in terms of potential future markets for liquidity. So we've been monitoring and understanding those changes in the bank, in the DCM markets, looking at, there's lots of new programs available supported by governments and central banks around the world. So yeah, looking at those and looking at whether any of those might be helpful for us.
Okay, and Paul?
Yeah, I mean, leaving aside the working from home element, and in fact, I'm working with particularly one client that I've never seen them face to face, even though they're only based in Essex. I think one of the key areas we've had a little bit of work and some inquiries and a few other things to do with has been thinking about the government programs that Steve referred to before. So particularly things like the COVID corporate finance facility and the CL bills and C bills and so forth. And certainly some of the questions that have arisen, and I was advising a client the other day about, is firstly consider whether you need this, obviously. Secondly, then consider whether, given that some of the costs of it are well documented, so for example with the commercial paper program that the government put out, there are some clear and understood ratings and therefore margins over the reference rate that you will be paying. But also be very clear that you are able to do this. So a lot of the financing that they may already have in place often has some form of permitted financing debt basket. So, it would be rather perverse in many respects to borrow £20 million off the government to see through the short-term problem, only to have your loan accelerated anyway because you triggered another level with another lender. Now, you may say, well, that's also a commercial discussion. You'd have that conversation with your bank, and if in getting that financing that stopped you going under, that's potentially a conversation worth having. But it's certainly a consideration that you have to give, rather than immediately be charging out and saying, great, the government's going to lend me some money, I'll have that, thank you.
Okay, and Eric, the investment case easier in this climate?
Yeah, no, it's an interesting one, right? So I think that if you think about the word of this crisis from a business perspective, that you've probably heard at least 2 or 3 dozen times over the past 2 days is resilience, right? And that has been in every discussion that we've had. And so if we take a business case to a CFO, or they're being asked by their investors, indeed, and talk about how we're going to build resilience into your business in terms of your cash flow forecasting, in terms of your working capital management, in terms of your cash management, that is pushing an open door at the moment. The platforms for resilience and sustainability, I don't think those will go away. I think that this move towards technology, this move towards having interconnected technology, it is the trends that were happening before this crisis, they're only being accelerated by the crisis itself.
Okay, that's brilliant. So we've got sort of last 10 minutes, and I've got a sort of couple of questions, and then I want to sort of finish with sort of one or two things you'd like to say with treasurers. Here's an interesting one. Why doesn't everybody produce a cash flow forecast?
Because it's hard. So, I mean, when you go into a carved out business that's been owned by a large conglomerate, typically the only cash flow forecasting that the finance team, which is often the finance team that was from a division, which has now become NewCo, has ever really had to do, they typically have been providing long-term cash flow forecasting or just accounting-based numbers, not quite take the annual number and divide it by 12, but often heading that way, figures to head office. And head office in turn has also then been relatively lowly levered with cheap and plentiful financing such that it hasn't bothered them very much. Providing an accurate cash flow forecast is difficult, and you often go through a number of stages. Some of it's technological, some of it's cultural, and some of it's just finding a way of changing behavior through a combination of KPI, sticks, and other bonus-related carrots. But most people in most finance teams, apart from the fact they're often very small and under-resourced, they haven't had to do it before. They're not very good at doing it, and initially they don't think it's a very interesting thing to do either. And they've often been very profit-focused rather than cash-focused. It's just excellent what they've done.
Okay. And here's a question, I think, on technology, maybe for you, Eric. Treasurers tend to stick with their TMS providers. Does this reflect a lack of dynamism or innovation in the Treasury tech space?
Well, I understand the question. It's a common debate. So my TMS doesn't do this, therefore I don't do this. And I think that has started to change to some degree on both levels. One is I think that some of these groups should really challenge their TMS provider in terms of what they do, because they've moved quite a bit over the past, I would say even the past 6 months. And the past 2 or 3 years, they've changed dramatically. So some of our old preconceptions about what a TMS can do based on current experience, I would re-challenge that, because I think there's a lot of capability that we don't quite unlock that they do have. And so go back to your TMS provider and understand what they really could do. It might be going back and looking at your data and data structures in order to enable that capability, but they might have that capability itself. And then there are sort of the elements where you sort of bolt on the pieces of true fintech and true innovation. And there's some amazing RPA tools, and the new word which is hyper automation, which we're now going beyond automation to hyper, right? But there is so much now that is out there in order to then augment a TMS, if indeed it can't do something, and connect it across your business. I think that challenging yourself with whatever problem you have or whatever sort of pain point you have, what is the solution? Because it's very rare that there's circumstances that the solution is just cost prohibitive, because it clearly often comes to that. But that would be my point on that common argument, Naresh.
And just sort of picking up one of these sort of words you used earlier in a debate I've heard, and I'm going to limit you to 2 minutes on this, no more, around structured versus unstructured data and sort of data lakes and data warehousing. Because I think this is something that has really started to over the last 2 or 3 years.
Absolutely. So there's so much value. I mean, everyone is understanding how much value there is in data, and so understanding the way that you utilize data and how it fits into the overall finance strategy, of which your treasury systems are a component. Understanding how your data strategy fits into your overall finance and treasury strategy to make use of what is hugely valuable underlying data is now that sort of, I would call it in the terms of hierarchy, the top level is getting the insight and value, but having that underlying core element of clean golden source data is one of the most the most focal points, the most significant focal points of the past, as you said, 3 years, and increasingly over the past even 2 months.
Okay, thank you. So we've got about 5 minutes left. We've still got questions, but I sort of wanted to ask each of you in turn one or two things you'd say to treasurers out there that they should focus on over the next 3 months and also over the medium term. And maybe start with you, Steve.
Yeah, sure. I think for me, and it's a very general point, but I think there's so much uncertainty and will continue to be so much uncertainty in terms of the impact on individual businesses and their liquidity that I think keeping plugged into that business internally is going to be key for everybody, so that you're really kind of on top of and adapting your plans based on what's happening on a day-to-day business kind of within the business, and also keeping plugged in kind of externally as well, as we've all talked about the kind of the different programs that seem to be at one stage they were coming out almost on a daily basis, but also conscious that the debt capital markets haven't closed. They've been very active, so actually just kind of making sure you kind of keeping that open dialogue with, if you have a relationship banking group, keeping an open dialogue with them, that's always a good thing anyway, but particularly at the moment to understand how those markets are developing as well.
Excellent. And Paul?
What I said at the beginning, focusing on the basics. You're trying to make sure that you can provide, through whatever way, enough liquidity for the business to operate, and therefore focusing on the building blocks to that intercompany framework, cash flow forecasting, visibility of cash pooling, getting the money back from overseas, but letting them have it back if they need it, pulling all that together and making sure that you can do what you need to do with the liquidity you have and make active rather than passive use of any other sources of finance you have, most notably an RCF, but perhaps an asset-backed program if you need to, and so on and so forth. But those are the things I would say. Most of the things I think most of the people here are doing to a greater or lesser extent anyway.
And just to add to that, I was talking to Bill Rigger from the US, Willis Towers Watson Week, and he was saying one of the things they've done is accelerated the frequency of they do their cash pooling. Yeah. So yes, it's back to what you said. You need the building blocks in place, but they sort of tweak them as we sort of move through the crisis.
And they're multiplicative as well, aren't they? Like I say, because you can't easily pool cash if you don't have the intercompany loan framework in place and so on and so forth. So they do all link together. If you get them all correct, then it all works better. It doesn't mean that you can, if the business is going to go under, for reasons not just liquidity, but where liquidity is just where it finally shows itself. You might not be able to save the business, but if things are marginal, you can certainly make a big impact, I think.
Yeah, so that's a good point. And Eric, a couple of last things from you.
Yeah, no, I got a message from my team that I should stop gesticulating with my hands, which I will do so now. I think I'll end with that, continuing with the word of resilience. So every corporate will be in a different place right now, and so we've had sort of the shock, and we're all taking a deep breath, and we're figuring out how we build a platform for resilience. Some of those take the form of very basic forecasting and cash management for those who haven't had that. And then there is some of the other groups that are looking at very sophisticated products and supply chain interaction. And it just really depends on where you are. But if you can get that platform, that platform for resilience, then you can really start to think about what's next. Until you do that, you're just sort of firefighting, as everyone has said.
Excellent. Well, we're sort of pretty much out of time. I hope you found the session as useful as I have. As you continue to support the liquidity requirements of your organization and new challenges over the coming months and years. Thank you all very much for the questions. We have quite a lot of participants, and I'm sorry we haven't been able to answer them all. But feel free to continue the conversation on the event app and do join in. A reminder, you can chat directly with fellow attendees, and a reminder, you can click through the agenda for a pre-recorded webcast of the other sessions that are available shortly after. Please take time to fill in this day. It's really important to us to make sure we've given you something useful and good use of your time. And a big thanks to Steve, to Paul, and to Eric for giving up the time this afternoon. And finally, I say goodbye and look forward to seeing you all tomorrow, which will focus on the regulatory challenges that lie ahead. So very exciting. Thank you, everyone.
Thank you.
Thank you.